to your portfolio, assets that have low correlation, he'll explain that, and what could be temporarily underperformance into a portfolio can help manage risk. And he says he's been zeroing in on bonds in particular. Joining me from Calgary is a familiar face, Martin Pelletier, Senior Portfolio Manager for Trivest Wealth at Wellington Altus Private Counsel. Martin, thanks a lot for joining us. Let's talk about the concept of correlation and why low correlation can be a valuable part of a investor portfolio.
So I call it adding guardrails into your portfolio. So you want to protect yourself from the unexpected. And right now there's a lot of complacency in the market and a lot of people fearing that they're going to miss out on the market rally. And so when things usually, I find in markets, things usually happen when you least expect it. And so the cost of adding some insurance or low correlated assets into your portfolio, when it's cheap to do so, it's probably not a bad time to look at adding it into your portfolio.
And what are some specifics that would fit that description? Is gold a low correlation asset?
Yeah, no, gold's been a really good hedge against what we're seeing on the tariff side. I think if we take a zoom out and we say, okay, what would be the risk of derailing things here and what's going to protect you? Well, take a look at, as you mentioned with your previous guest here with Walmart, it's selling off 6% today about some of the Canadian and Mexican tariff threats. We think that higher importing prices would impact the U.S. consumer and potentially send it into a recession, and that would cause interest rates to fall faster than what many expect. And so that would be really good for bonds, for example. Also, if you look at the option market, there's some really good trades there that you could add some put protection and sell some calls, just to add some income into the portfolio and using that income to buy some insurance. And then there's structured notes that are also an effective tool for us.
So you've been you're moving into you've increased your clients' holdings of bonds. What kind of bonds are those, and why are they? Why have you made that decision?
Yeah, and so as I had mentioned previously, there is the risk that these tariffs could send the U.S. into a recession. We think that risk is not being factored into the market. If you take a look at what's leading the market this year, it would be the more broader segments as people are moving out of the S&P broader into the equal weight, which is outperforming. And so that's not being discounted into the market. And so if there is any chance of the Fed accelerating rate cuts, and everyone's looking at tariffs from the inflationary aspect, which is probably the case in the near term, but longer term, as it works its way into the economy, it would have to have an impact on that consumer. And so that would cause the Fed to lower rates at a faster clip. And so long duration assets are going to really benefit from that. And so looking at the TLT, which is a U.S. 20-year Treasury, that ETF is down 40% from 5 years ago, and is very sensitive to interest rate cuts. And so, and also, if you take a look at that particular ETF, the short position is at all-time highs, the level of short interest on that ETF. So if there's any catalyst to cause a short covering, you can see some good trade, a good trade there, and some nice gains.
You say timing the markets is impossible, and I think many retail investors understand and agree with that, but you say timing your risk exposure is not impossible. That's an interesting thought. Expand on that. So,
as I mentioned again, the level of complacency, if you take a look at the short volatility bets, it's the highest it's been since July of 2024, of this time July of last year, when the market fell by 10%. Seems like a long time ago, but it really wasn't. And so right now, the level of optimism in the market in regards to the forward direction is making calls very expensive and making puts very inexpensive. And so what I mean by that is it's really inexpensive to add insurance in your portfolio and to use by selling calls to pay for that insurance. And you can use some ETFs to do that, or you could do it in the option market yourself. We use the HEQT, the Simplified Hedge Equity ETF, which does a put spread call strategy that does exactly that. So it's adding some downside protection for a very low cost, and it allows you to stay invested. And so again, you want to add insurance when you don't need it, because when you do need it, it's nice to have there.
So we've talked about a number of strategies. What we haven't talked about yet is just good old-fashioned buying stocks and holding them. Is this what kind of environment do you see out there right now for just buy and hold investors?
Well, if you're already invested, adding, again, some insurance on that existing portfolio was good. Going into the market at this point in time is tough. I mean, timing the market is, as you had mentioned, impossible to do. And so investors who sat on cash, and we fielded some phone calls about some new potential investors with us that have been in cash the last 12 months, and they missed out on some really good opportunities. And now it's like, well, do we go in with multiples being where they're at? And so we're using things like structured notes where we can have 50 to 100% downside protection with 8 to 12% upside. Or using those options where we can have some 15% downside protection and upside capture of 15%. So in this market where multiples are at, I think if we can get client returns of 10 to 12%, they'd be very happy, and giving away the upside beyond that to have downside. And so that's the type of strategies I would be looking at if you're going to be going into the market and buying in today's environment.
Martin, thanks as always for this conversation. Martin Pelletier is Senior Portfolio